Hi, and welcome to our end of the year update from the Wealthy Doctor Institute. Physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with their current investing strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those of you who are new to the concepts of the book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So this month is actually the end of the year review of our systems. I purposely do an end of the year review just to see where we are with the big picture and not doing most other months because, remember, investing is a marathon. You concentrate on one step at a time. If you look at the big picture too often, it can be emotionally intense, and that's when we begin to self-sabotage. So concentrate on the mechanics most of the time, but periodically check to see where you are. So I typically check once a year. However, I also do a summer review in June just to see where we are at a halfway mark during the middle of the year. So in this month, we'll review our systems, namely the 20-month Simple Moving Average System, the Monthly Rotation Investment System, or the MRI system. I'll look at the Dalio All Seasons portfolio. This one I definitely only review maybe twice a year because really there is no adjustment to this except once a year. Touch base on the trailing stop-loss system for those of us who really want to invest in individual stocks for some reason. And then finally, a closer look at Sector Surfer and how, ever since I've been using Sector Surfer, it's been touching many of these systems. So let's get started. The first system is the 20-month Simple Moving Average System, abbreviated to 20-month SMA. The rules of the 20-month Moving Average system is very simple. If the price of the S&P 500 index is above the 20-month Moving Average, it's relatively safe to stay invested in the index fund. Otherwise, get out. The 20-month moving average is our safety belt. It only works if we watch it every month, but no more than once a month. So here's our updated graph. If you take a look at the last day of the year, the VFI index, or the Vanguard S&P 500 Index Mutual Fund, ended at a price of $246.82. The 20-month moving average also rose to $213.82. However, if you make this calculation, the cushion has increased to 15.4%. In other words, the stock market has been rocketing up so fast that it's been leaving our moving average in the dust. Now you can interpret this any way you want. The markets are either going up really well, or you can say that the markets are going up too fast. But it doesn't really matter how we interpret it. The only thing that matters is that this number, the price of the S&P 500 Index Mutual Fund, is above the 20-month moving average currently. We don't do anything until this number is below this number. We don't know when that will happen. It could be next month. It could be a year from now. It could be several years from now. Doesn't really matter. We don't take action until this price action inverts. So here's the effect of switching between the S&P 500 Index Fund and the long-term Treasury Bond Fund based on the 20-month moving average. So if blue is buy, hold, and reinvest dividends, the green is switching between stock and bond mutual funds. Now again, you're probably noticing that, wait a minute, if stocks have been increasing all the way up until peak of 1999, why is the green line lagging the blue line? And that's because, to make a fair comparison, if you were to have some money manager do this for you, and they charge, for instance, 1% fees, the green line would be net of fees, whereas the blue line would have been if you just bought, held, and reinvested yourself. Of course, ever since last year, we've started to cover Sector Surfer and specifically its version of the 20-month moving average, which is the Storm Guard Armor. Remember, these are similar but not exactly the same indicators. And all they're trying to do is try and figure out whether or not it's relatively safe or dangerous to be in the stock market at any one time. So if you take a look at the 20-month moving average, it's a first order filter. It looks at only one variable at a time, whereas the Storm Guard Armor looks at 3 separate variables and comes up with a single number to see whether or not we're relatively safe or dangerous in the markets. Now, the advantages of Storm Guard Armor is that even though it generates more trades than the 20-month moving average, it's had fewer whipsaws per trade so far. And we've seen back in 2015, 2016, where whipsaws can really cut into our effectiveness. So here's a head-to-head comparison between the S&P 500 index, buy, hold, and reinvest, versus the green line, which is using the 20-month moving average to switch between stock and bond funds, versus this purple line to switch between stock and bonds using the Storm Guard Armor. So you can see the effects of whipsaws. Remember 2015, 2016, we actually experienced decrease in the markets, even though the markets themselves were relatively flat. Same thing back in 2011. We don't see quite as many whipsaws with the Storm Guard Armor, although 2016 was pretty challenging. It was quite an interesting year. In fact, the differences are so dramatic that instead of using a linear axis to try to represent all 3 strategies, if we use a log graph, it's easier to see some of the nuances between all 3. Now remember, with a log graph, distances between ticks are approximately equal in magnitude. For instance, difference between this tick and this tick is 10 times, and then distance from this tick to this tick is also 10 times. So in terms of percentage gains and losses, it's easier to gauge visually how these percentages work out with a log graph. So for those of you who like numbers, here's a table of the numbers, comparing the S&P 500 index versus switching between stocks and bonds using the 20-month moving average versus switching between stocks and bonds using Storm Guard Armor. Now, you can freeze this video and take a look yourself, but let me point to you a few features that I put into this table. I specifically highlighted negative years in red, so they're visually easier to find. You take a look at the annualized return. Now remember, annualized means compounded average growth rate. It's not a mathematical average. So for instance, an example would be if a stock went up 50% one year and then down 50% another year, mathematically it would be 0, right? 50 plus minus 50 equals 0. Divided by 2 is 0. But in actuality, if you have a $100 stock goes up 50%, that's 150. When it goes down 50%, it's down to 75. So you actually lost 25%, which means you had an annualized loss of 13% per year. That's what I mean by annualized. It's a more honest way of looking at market returns. So if you take a look at the annualized returns of just buying, holding, and reinvesting stocks, you gain 10.5% per year on average. So if you take a look at the annualized return of the system switching between stocks and bonds using the 20-month moving average versus just buy, hold, and reinvesting dividends, there's a difference of 1.3%, which translates to a 43% increase over the last 28 years. So little things mean a lot. Plus, if you take a look, in 2017, all 3 systems has been in stock. So why are these 2 systems decreased compared to buy, hold, and reinvest? Because again, I'm trying to show the effects of if you were to outsource switching between stocks and bonds to some money managers who are charging, let's say, 1%, then these growth rates are net of fees. So if you were to do this yourself, you might actually do a little bit better, if you have the discipline. But if you have someone else doing it for you, returns are a little bit less. But even then, just a small percentage means a lot, which means when we use Storm Guard Armor and the annualized returns are almost 5% greater, then the differences after 28 years is even greater. So the next system is our monthly rotation investment system, abbreviated to MRI. The MRI rules are very simple. All you do is take three funds, the S&P 500 Index Fund, the Emerging Markets Index Fund, and the Inverse S&P 500 Index Fund. Every month, rank these three funds. Sell the bottom 25% of your portfolio and buy the top fund. So here's what we're doing this month. Last month's data, this month's data. Now for some of you who are astute, you'll see that the Emerging Markets Fund had dividends this month. So that means this number is different from last month's video. Because remember, we're dividend correcting. So dividend corrected data, current data, divide, and you see that there's a clear winner this year. That is the emerging markets. The S&P 500 index is almost flat. It actually went up 0.6%, whereas the inverse fund went down almost a whole percent. But you can see graphically how the green and blue lines have been almost flat, whereas the red line has been trending up since December 7. So with the current model, last month we were roughly 3/4 in the emerging markets and 1/4 in the S&P 500 index. Since we're supposed to sell this and buy the emerging markets, now we're back to being 100% in the emerging markets. So here we have the MRI components. The S&P 500 index in blue, the emerging markets in red, and the inverse S&P 500 index in light green. And if you take a look at what happens when we superimpose the MRI is now outperforming all three components. That's what mechanical sector rotation does. However, again, if we were to use Sector Surfer's version of sector rotation using these same three funds, you would see that the blue line is the S&P 500 Index Mutual Fund, the green line is the MRI as described in my book, and the purple line is sector rotation using the same three funds using the Sector Surfer strategy. In fact, again, the differences are so great that you have to go to a log graph to see the nuances in the differences. And again, here is a table version of comparing the S&P 500 index to the MRI to the Sector Surfer version of rotating those same three funds. Again, I highlighted all losses in red, and even with Sector Surfer using those three funds, there can be a large loss here, but for the most part, the Sector Surfer strategy seems to be more robust in that if there are losses, they tend to be relatively small. And if you take a look at the annualized returns, again, for the S&P 500 index, we annualized 9.77% return per year over the last 22 years. The only reason why we use 22 years in this example is because we only have that much data for the inverse fund, whereas with the MRI, even when correcting for fees, we're beating the S&P 500 by almost 2 percentage points per year, which makes a 43% difference over 22 years. And then, of course, with the Sector Surfer, we're annualizing 15.2%, again, correcting for net of all fees. So the obvious question now is, can we combine and improve? And of course, yes, we can. In fact, these two systems, using bull versus bear market indicator and using a sector rotation optimizer, we can combine the two using the safe versus dangerous for stock indicator, such as a 20-month moving average or the storm guard armor, decide whether or not it's safe or dangerous to be in the stock market. If it's safe, then all we do is rotate only through stock funds. And if it's dangerous to be in the stock market, then we only rotate through the non-stock funds, typically bond funds, cash, or maybe even inverse funds. So here's the analogy. If you take a look at the seesaw, it's either down one side or down the other side. Or if you want to be more optimistic, up one side or up the other side. All depends on this fulcrum here, which is called the indicator. Pick your pick, moving average or the storm guard armor indicator. If the markets are relatively safe, markets are safe here, then we rotate using only stock mutual funds, whereas when stocks are dangerous, then we only rotate through non-stock funds. So can we improve on a pie chart? This is what we're taught to do. We're taught to diversify and rebalance. We're supposed to put a little bit in stock market, real estate, international stock, emerging markets, bonds, and tips. And although there are many variations on the pie chart, I took this specific pie chart from Tony Robbins' Money Master the Game book. This is, in fact, the David Swensen portfolio. He's this famous guy from Yale who has been making 14% per year on average for the Yale Endowment Fund for decades. He's a legend, and this is the same portfolio that he recommends for his own family. So let's take a look at how this particular pie chart works. If you take a look at all the various components, the yellow line is how the pie chart would have performed by rebalancing quarterly. So if you take a look, the yellow line is beating the S&P 500 index. It's averaging around 8% versus S&P 500 7.3%. But if you take a look, it can be volatile, such as 2007, 2009. It can also lose money. Whereas if we were to rotate using the sector server method, we can increase returns to 16% annualized per year, making approximately 5 trades per year. Now, if you were to split apart the stock from the bond funds and use stock funds only when it's relatively safe to be in the stock market, and use bond funds only when it's relatively dangerous to be in the stock market, then we will get this result, which is here are the 4 stock funds. The 2 bond funds are here, using StormGuard Armor to differentiate between the 2. Now we're trading only 4 times a year, with a smoother graph, increased return. If we take care of the risk and let the returns take care of themselves, we can actually improve on traditional pie chart investing. So again, rotate only among these funds when it's relatively safe for stocks, and when it's dangerous for stocks, rotate among these bond funds. And here is another way of looking at the data. If you take a look at this growth curve, all their colors represent whenever it's in one of these funds, and the white is when we're in a bond fund. So remember, Sector Server comes with a free strategy. When you sign up for your initial free account, you get 1 free strategy. And here it is. The example free strategy uses stock and bond funds in the rotation and uses a earlier version of StormGuard. There are obviously better systems that you can produce yourself or even modify, but once you modify or make your own custom strategy, you will need to pay a nominal fee around $10 per month to have the system generate signals for you. Having said that, this month we actually have a trade alert on this example free strategy. So if you take a look at the Sector Server website, the example free strategy says, on this date, generate a signal to sell the small cap stock fund and buy the large cap stock fund. So once you see what this trade is, and usually when it generates a signal, it will email you, it will text you, you will get notified, and then you log on to Sector Server, see what trade you're supposed to make that trade, log back into Sector Server, and then this red acknowledge trade, you click on it, and it turns into a done button with the date that you did it. So remember, Sector Server has 2 main tools. It has the StormGuard Armor, which differentiates safe for stocks versus dangerous for stock zones, and then it uses a sector rotation mechanism to optimize the safe for stock phase of the markets and the dangerous for stock phase of the markets. Remember that if a strategy is set up properly, you will get a signal through email or text. Now me, I log in periodically just to make sure I don't miss any trade signals, just because since now I'm doing this professionally, I'd rather not miss a signal. But if you're doing this by yourself and you only have 1 or 2 accounts, the likelihood that you miss a signal is relatively low, provided you set this up properly. So remember, with Sector Server, if you set up properly, you will get a signal through email or text. Now me, I log in periodically, around once a week at least, just to make sure I'm not missing any signals. And that's only because as a professional, I monitor several strategies at once. But if you only have 1 or 2 accounts with maybe 1 or 2 strategies, the likelihood that you would miss a signal is relatively low, but if you're anal like me, you might want to log in periodically anyway. So the next system that we'll review is the Ray Dalio Portfolio that has been reviewed in Tony Robbins' book Money Master the Game. Now, the Ray Dalio Portfolio is a pie chart. You only rebalance it once a year. But in terms of pie chart constructions, this one is actually relatively robust in that whereas most pie charts have historically lost double digits during really bad bear markets, this particular system has not seemed to lose more than 4 or 5% in any one year so far. So this is the theory behind the Ray Dalio All Seasons Portfolio. You think about the economy, there's only two indicators that Ray Dalio looks at. Either there's economic growth or economic shrinkage. And then there's either inflation or deflation. Based on these two factors, different asset classes perform differently. So if you were to combine these asset classes into this particular pie chart and then rebalance every year, you would get results somewhat like this. So again, I'm listing all the various components. You have the stock represented by S&P 500 index, the intermediate term government bonds, the long-term government bonds, gold, and commodities. And the weighted is the performance of the pie chart. So if you take a look, I've highlighted all the times when there have been losses in red. However, if you take a look at the combination of all these components in these particular ratios, you would see that performance-wise, at least back to 25 years, there has been only 4 years where it's lost money, and it's never lost more than 5% so far. Now, the overall performance, stocks have been performing 9.48% annualized return for 25 years. So the portfolio has lagged it somewhat, but then again, remember, any pie chart, all it is an average of its individual components. So it will never do as badly or worse than the worst fund, but it will never do as well or better than the best fund. However, if you take a look at the performance, this black line is fairly smooth compared to its various components. So the next system we'll review is a 25% trailing stop loss system. This system is used when you really want to buy a single stock for some reason. So the rules are simple. If you really want to buy a stock, limit risk to only 1% of your portfolio or trading account. Buy up to 4% of your trading account with that one stock. This way, if it falls 25%, you only lose 1% of your portfolio. Now, if the stock goes up 33%, buy another block of stock using another 4% of your account, because when the stock goes up 33%, if it falls 25%, it's basically break even. So your loss or your risk of loss has been cut down severely. And of course, every time you buy stock, you're going to have to update your trailing stop loss order to reflect the increased number of shares. And then keep repeating until stopped out. So in summary, we've reviewed several different systems. Don't mix up the systems. With the possible exception that with Sector Surfer, we're combining two different systems. We're combining a system that differentiates between relative safe and dangerous times of the markets, and then within each phase of the market, we're rotating through and optimizing as best we can the trend within that phase of the market. So we review the 20-month moving average system, the MRI monthly rotation investment system, how to deal with stock tips, and then of course we review the Dalio All Seasons portfolio. So keep those questions coming. I know I talk to several of you personally each month, and I realize that for some of you, these video updates are not enough, especially if you're still unhappy with your current investing strategy or lack of strategy. I'm going to offer a complimentary investment, wellness, checkup, and breakthrough session for you, just you and me. Ask all the questions you want, no matter how seemingly basic or clueless you think you are. In our checkup and breakthrough session, together we'll create a sense of clarity about the financial future you really want, the reasons why you're investing to begin with, and how to get you there. Discuss the investing building blocks that are more specific for your situation. Determine what has stopped you in the past from getting what you want now. And identify what are the more important steps you need to take now to get your investing and financial goals, and then complete our consultation with the excitement of knowing exactly what to do next to create that road to your future you really want. Think CME, only the topic is financial and tailored to you. Think wellness checkup, because whether or not you feel financially well, if you had a financial cancer or blind spot you didn't know about, wouldn't you rather at least know so you can deal with it before a problem becomes too big to handle? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next time, invest safely.